All right, today we are diving deep into the high stakes world of mergers and acquisitions. This is the ultimate corporate strategy game. We're talking about titans of industry being bought, sold, and smashed together in deals worth billions upon billions of dollars. But what's really driving these massive deals? And maybe more importantly, why do so many of them seem to just fail? Let's get into it.
This old saying pretty much sums up the entire world of M&A, doesn't it? It just perfectly captures that core tension, that push and pull that drives every single deal. On one side, you've got a buyer who thinks they see some hidden potential, some untapped value. And on the other, you've got a seller who's willing to part with their creation, but only for the right price. And right there, that's the spark that gets the whole engine running.
Okay, so you'll hear the words merger and acquisition thrown around like they're the same thing, but technically there's a difference. See, a merger, on paper, is when two equal companies come together to form a brand new one. An acquisition, on the other hand, is just a straight-up takeover. But let's be honest here. These true mergers of equals, they're basically unicorns. They're incredibly rare. In the real world, one company is almost always calling the shots, which means pretty much every deal is, at its core, an acquisition.
So, what is the logic behind all these giant corporate shakeups? Well, it usually boils down to one single, very optimistic and kind of fancy word. And that word is synergy. This is the magic concept, the central belief that's at the heart of almost every single deal announcement you'll ever read. The whole idea is that by combining forces, these two companies can create something way bigger and better than they could on their own. Things like massive cost savings because you don't need two accounting departments, right? Or new revenue because you can sell your products to their customers. It's the beautiful, optimistic promise that somehow 2 plus 2 is going to equal 5. But is that beautiful idea of synergy the only reason companies decide to merge? Well, the official press release will tell you one story, but the reality? It's often a whole lot messier. Okay, first up, you've got the textbook reasons, right? These are the official strategic justifications you're always going to hear about the news. A company might want to instantly gobble up more market share or get huge cost savings by becoming bigger, that's economies of scale, or maybe they just want to take a tough competitor off the board. And sometimes it's just way easier to buy cool new technology than to spend years and millions of dollars trying to build it yourself. And look, these are all totally sound, logical business reasons. But then you have the real reasons. Or at least what a lot of skeptical analysts would say are the real reasons. They'd argue that a lot of these deals have less to do with smart strategy and more to do with, well, human nature. We're talking about things like good old-fashioned empire building. A CEO's ego just itching to run a bigger and bigger company. Or pure hubris. That's when executives get so overconfident they think they can make any deal work, and they usually end up overpaying like crazy. And then, of course, there's simple executive self-interest. $23 million. That is how much F. Ross Johnson, the CEO of RJR Nabisco, got as his golden parachute after his company was sold in one of the most famous takeovers of all time back in 1989. Think about that. He lost his job, he was pushed out, but he walked away with $23 million. It's just a wild example of how a massive personal payday for the execs can be a pretty powerful motivator to get a deal done. Okay, so the motivations are there. Now for the really big question. How on earth do you actually pay for a multi-billion-dollar company? Turns out the choice you make, basically cash or stock, sends a massive signal to everyone watching. So an all-cash deal is pretty simple to understand, right? It screams confidence. The acquiring company is putting cold, hard cash on the table, even if it means taking on a mountain of debt. And for the sellers, it's a sure thing. They know exactly how much money they're walking away with. Now, a stock deal is different. It's like the acquirer is using its own stock as a form of currency. And sometimes, this can be a bit of a red flag. It might signal that they think their own stock is a little overpriced. For the sellers, it's a totally different game. They're not cashing out. Instead, they're taking a bet, rolling the dice on the future of this new combined company. And you can see right here how that choice really impacts everybody involved. If you're a shareholder in the company being bought, cash means you get a clean break, a nice payout. Stock means you're now buckled in for the ride, sharing in all the future risks and rewards. And what if you're a shareholder of the company doing the buying? Well, a cash deal probably means your company just took on a lot of debt. A stock deal means your ownership stake just got diluted. Basically, your slice of the pie just got a little bit smaller because the company printed new shares to pay for the deal. So yeah, how you pay is a really, really big deal. So the second that deal is announced, Wall Street basically becomes the judge, jury, and executioner. All at once, instantly, traders and investors start placing their bets, voting with their money on whether this whole thing is a brilliant masterstroke or a complete and utter disaster. And the very first thing you're going to notice is something called the acquisition premium. Think about it. To get shareholders to agree to sell their company, you can't just offer them today's stock price. You have to sweeten the deal. You have to pay a premium. And usually that premium is somewhere in the ballpark of 20 to 40% above the current price. For the shareholders of the company getting bought, that's their instant payday. This all leads to a super common pattern that you see on the day a deal is announced. The stock of the company being bought, the target, it just skyrockets, right? It jumps up to meet that juicy premium. But then you look at the acquirer stock, and it often takes a hit. It goes down. So why is that? Well, the market starts to get jittery. Investors start worrying that the buyer paid way too much. That's what they call the winner's curse. Or they get scared that the messy, difficult process of smashing these two companies together is just going to end up destroying value instead of creating it. All right, so after all that initial market chaos, the deal moves into its final stages. And for most of us, for the average investor, this is when it all gets real. This is what you'll actually see happen in your brokerage account. So, what actually happens if you own stock in a company that gets bought out? It's actually way simpler than you might think. First, after all the lawyers and regulators do their thing, the deal officially closes. Then, the company's stock ticker, it just disappears from the stock exchange. It gets delisted. And finally, and this is kind of the magic part, you literally don't have to do a thing. Your broker handles everything. One day, you'll log into your account and your old shares will just be gone, and in their place, you'll either see a pile of cash or brand new shares in the company that did the buying. Simple as that. But here's the kicker, the really sobering truth behind all the flashy headlines and the mind-boggling numbers. Most mergers fail. I'm serious. Study after study shows that a staggering 50 to 80%, let that sink in, 80% of these deals do not hit their financial targets. Whether it's because the buyer overpaid, or the two company cultures clashed like oil and water, or the integration was just a total mess, a huge number of these deals end up destroying shareholder value, not creating it. So the next time you see one of those massive breaking news headlines about a mega merger, you'll know what to look for. You'll have the tools to look past all the hype and ask the right questions. Is this really a brilliant strategic move that's all about synergy? Or is it just an ego-driven gamble that's probably doomed to fail? And figuring out the answer to that question, well, that's the difference between creating billions in value or watching it all go up in smoke.